Thank you very much for having me here today. I appreciate the opportunity. It's funny, we, at the department, we get invited, obviously, to do a lot of presentations. During budget season, not so much. We're pretty much in working in the office. So this is actually probably my first presentation in several months. So I'm actually slightly nervous about this one. But hopefully I'll get back in the swing of things, if I can figure out this microphone. Is that gonna work? There we go. That'll work. Okay. So for my part of this particular course, we have a number of different things that we're going to talk about. But before I get too deep into the agenda, first I wanted to see by show of hands how many of you have gone through a DLGF budget training type presentation in the last year or so. Okay. All right. We've got some of the same information. So that I wanted to just kind of see where everybody stood. We are very fortunate that this past General Assembly session did not result in significant changes to our budget process. So this will be, I believe, our third year of fairly stable a budget process in terms of deadlines and things like that. So that is great. Also for our purposes on Gateway, we don't anticipate any major changes. We're just really working on some minor improvements. So for those of you who have been using our online Gateway system for preparing and submitting your budget forms, hopefully you'll only see improvements and no significant changes this year. So I know people are always a little worried about, are we going to totally revamp the system and do I have to relearn it? So not this year. For the purposes of this class, I first actually wanted to start with just a fairly quick discussion on why budgeting is important, especially given this class and given that it's officials from all different offices. I thought that might be an important step to just kind of talk about the budget process in general, really what it means, how it can be used. Then we will give a quick update on 2014 and where we stand. Then we'll get into the 2015 budgets in terms of our timelines for the upcoming budget process, as well as discussing non-binding recommendations and binding adoptions. Then to add some new information, I've tacked on a section here about maximum levies, not just for certain levy-controlled funds, but really talking about all the different types of funds that units will have and how we arrive at what the maximum levy will be in each of those funds. So that's something that we don't normally talk about, but I'm hoping that that's some good information. And it's also applicable to all of the different office holders because it's important to understand why a county or a taxing unit has a particular constraint in terms of how much they can tax. And then lastly, I have a section about protected taxes. This is something that is new for 2014. It is finally going into place. It's been on the horizon for a couple of years now, and it is actually being implemented now. So we'll talk about that a little bit. That is my main plan. After that, if we still have time, I do have some bonus material thrown in here, but we'll see if we can get to it or not. If we don't get to the bonus material, it is in the PowerPoint. And it's really just some examples of how circuit breakers work and how the various tax rates of all of the different taxing units come together and ultimately will impact what the property tax caps are and how much money each individual taxing unit is getting. So hopefully, even if we don't get to it, it's broken out in just some tables, and hopefully you can kind of flow through those a little bit. But if you're looking at those after the fact and you have some questions, certainly feel free to contact me, and I'm happy to talk through those slides as well. All right. So the importance of budgeting. We always talk about the budget. And I think it's very easy, even for me in my role, to start to think of the budget as just a bunch of numbers. It's just something we have to go through, and there's just a ton of numbers on there. But it is a really important document from a number of reasons. First and foremost, it is a legal document that sets legal limits. In particular, it's going to establish your legal limits on what you can spend in each particular fund and category, and even line items as you go further into the budget reviews. It also will set some limits on how much you can tax your taxpayers. And then lastly, how much the tax rate would be. The tax rate is important because of the impact that it will have with circuit breakers. So this budget document really is a very important document in terms of setting these overall limits. In addition to that, this is kind of the warm and fuzzy part of the budget document. The budget really is a way to identify what the priorities of a particular taxing unit are. You have, as a taxing unit, you have a set pool of money that you are able to direct to any number of services. And so as you are choosing to direct that money to this particular program and not to a different program, that is an indication of your overall priorities for your organization. So I like to kind of emphasize that just to say, as you're starting this process, that may really be where you want to start, is to say, what are our priorities? And just look at that as your starting point to form your basis of where you will actually be funding. Then your budget will also help to define the organization of your taxing unit, how you will get things done. Particularly as you go down to the individual line items and you are funding salaries in a particular office, that is an indication of how you will operate in that office. So again, just something to keep in mind. And lastly, the budget is a communication device. It is a great way for you to communicate amongst yourselves, amongst the local officials, but also then with your taxpayers or with any businesses that may be in your particular area. It's a good way to show them, here's what we are trying to do, here's why we're trying to do it. For our purposes, with our annual budget process, obviously there are particular forms that you are required to fill out. There's no reason why you can't go above and beyond if you wanted to look at that a little bit more fully and kind of put together a nicer package than what our forms would produce. Just as a way to be able to show your taxpayers, here's what we're doing for you, and here's why we're doing it. So as we talk about the budget cycle, this is just, as I think through the budget cycle, this is kind of how I picture it. First, like I had said, first you have to start from your priorities. What do you want to be funding? Then from there, once you have identified what your priorities are, then you get to a matter of, okay, we want to do this. Can we actually fund it? And so for that purpose, as in the funding block here, I kind of group in both what are the expenses associated with providing that service, as well as what are the revenues that are coming in, because that's really going to determine whether or not you have funding for that particular service. Then from there, once you've gone through, you've established this is what we want to do, and we're directing resources towards that particular task, then it's time to get the work done. That's where I have operations. That's really just a matter of going through, in our case, we normally talk in an annual budget year. So going through that annual process of fulfilling your duties that have been outlined in your budget document. Throughout that process, you also will be doing reporting and taking a look at, okay, where do we stand against budget? Maybe you're looking at that monthly or quarterly, just kind of getting a feel for how you're proceeding through your operations phase. At the end of a particular budget cycle, obviously there's a lot of reporting that occurs. At the state level, we would be looking at your annual financial reports that are required to be provided, as well as then the State Board of Accounts audits and examinations that they will complete. Then lastly, you go to reviewing. How did you do? Did you meet your priorities? Do you need to reconsider? Do you need to redirect resources? And that's kind of then, as you start to do that, that helps then frame your priorities for the next budget cycle. Let's see. Yeah, this particular budget cycle, it is an ongoing process. Like I had said, for our purposes, for the DLGF purposes, it's very easy for us to always talk in terms of your annual budget. But this budget cycle is something that you can be doing on both a much shorter time frame as well as a much longer time frame. And really it is something that you should be doing, continuing to revisit it. So from the short term, like I said, maybe you look at things on a monthly basis or a quarterly basis. Longer term, as you may have large capital projects that you're looking to do within your taxing unit, maybe you're looking out 3 or 4 years in order to determine and plan for those particular projects. At any particular point in time, it is very easy for a taxing unit to be concerned about multiple budget cycles, or in this instance, multiple budget years. So let's say, as of today, here are some things that a taxing unit may be looking at. For the purposes of last year, pay 2013, they may, hopefully you've already filed your annual financial report, and actually I believe all the counties have, so good job for that. But if you've already filed your annual financial report, then maybe right now you're preparing for State Board of Accounts to come in and do their audit and examination. For the purposes of 2014, you're currently in that operations mode. So you're monitoring your current spending. You're seeing how things are going. Are you accomplishing what you intended to accomplish? You're also now at the start of your 2015 budget cycle. It seems like it never ends for me. As soon as we walk out of 14, we walk right into 15, and I'm sure you all feel the same way. So right now we've got 2015. We're gonna start to get ramped up for that. From our standpoint, we're gonna start to release our guidance, opening up Gateway, things like that, probably in the next month or so. So again, it's time to start to think about things that are 6-7 months from now. And lastly, you may also be looking even further out than that. You may be looking at 16. Maybe you're planning on, doing a particular road improvement in 2016. So those are all different things, and it's interesting because at any point in time, you've got so much that you're juggling between those various budget years. And I really kind of wanted to point that out because I know with many of the other county offices, you're in a similar spot. I'm very familiar with the assessing side, and so obviously as an assessor, you're looking at past assessment years for the purposes of appeals. You're looking at your current assessments to try to get them done, and you're starting to prep for, in this case, cyclical reassessments and things like that. And I'm sure a lot of the county offices are in a similar boat where you have this ongoing process that you're looking at. And so budgeting is the same thing. Much of our guidance seems to indicate that it's, these are the months you look at it and that's it. But it really is a complete picture and really an ongoing process for each taxing unit. So even though I'm sitting here talking about how this is, we can't just look at individual years. We always have to come back and look at individual years and see where do we stand. So this is our status update for the DLGF. And I am incredibly excited about where we ended up for the 2014 budget cycle. We did have 91 budget orders certified by February 15th. That is, as far back as we can figure, that's the first time that's happened in probably about 15 years. So we have made significant improvements on our side, but really our success has largely been driven by all of the different taxing units. As everybody has gotten back on track with on-time billing, left over from our 07-08 timeframe of reassessment issues, and now we've gotten everybody up to speed on Gateway. This process, it just feels like we're really starting to move along so well, and the whole state just really seems to be working as a team to get this done. And so I definitely appreciate all of the local officials who keep their units on track so that then the department can stay on track as well. In addition to our 91 budget orders by February 15th, I am possibly even more excited to say that we certified the LaPorte 2014 budget order on March 11th. For those of you who may not be familiar, LaPorte had an issue back in 2007, and we have been working to get them caught up from that issue for the last 7 years. In particular, I've been in the budget division. It'll be 3 years in June. I have done 7 budget orders for LaPorte County in the time that I've been in the budget division. So I'm just really excited about the dedication that they have shown up there to get them back on track. We finally can start to talk about 92 counties again. It's amazing. I'm not sure. It's going to take a while for us to adjust to that. In terms of on-time billing, We do anticipate at least 91 counties to have a May 12th due date. This year we are on a May 12th due date because May 10th falls on a Saturday. I say at least because we're still working with LaPorte to see can they get their bills turned around in time to get to a May 12th due date. They actually just had their abstract approved yesterday. So for those of you in the auditors and treasurer's offices who understand the amount of work that needs to be done from that point in time to get the bills out, they've got about 2 weeks to do a lot of work if they're going to get to on time. Even if they don't get to on time, though, they will not have provisional bills. They will be in a reasonable time frame, most likely in May billing. So excellent work for them. All right, so let's jump ahead to 2015. Let's start to talk about where we stand for 2015. It is time to start to prepare already. So some of the ways that you can start to prepare right now, be reviewing your current expenses and your anticipated status for your 2014 budget. Do some projections. By the end of this year, where do you think you're going to end up? Are you going to need to do additional appropriations? Or is it possible that you actually have maybe too much money budgeted in this particular area, and so you might want to do a budget reduction because of the way that that would interact with your next year's budget? So those are some things to look at. Also, start outlining your priorities. Like we had talked about, priorities really kind of set your path for your budget documents. Start to create a calendar that your particular taxing unit will use to keep you on track with the budget process. Statutorily, there are a few very, very key dates that, unfortunately, if you miss them, we don't have a lot of leeway to help you. And so in that instance, most often that means that we would be continuing your prior year budgets and levies into the next year. So we'd take your 2014 budgets and levies, and that's what you would expect for 2015. That means you would lose out on the opportunity to grow your property tax levy. So we really don't want that. We really do want everybody to have the opportunity to implement their budgets the way that they would like. And so there are certain key dates that we'll talk about that really need to be hit. So starting to prep the calendar is highly important. For our purposes, some of you may be wondering about our budget calendar. We have a draft of it that we are finalizing. I am hoping to get that out very soon. We did want to wait until after session to see if session was going to change anything significantly. So we're working it through our legal review process right now. The other thing with your calendar is that I do encourage you, if it's possible, I would encourage you to take action early. And actually at the county level, you all have actually more flexibility than the other unit types, because other unit types, one of the things we'll talk about is non-binding review. They have to wait until you do that before they can really move forward with their budget adoption. So there's kind of this relationship there that they need to make sure that they don't get ahead of you all in terms of doing that particular work. For a county unit, though, you have the ability to really dictate your calendar. One of the reasons why the department says to take action early is if something happens and something goes wrong, particularly when it comes to your budget adoption, if that goes wrong and you adopted maybe in the start of October, you have a few weeks there to get that fixed. So certainly if that happens, reach out to your field rep. Your field rep can work with you to figure out where we go, whether or not we can fix it, and if we can fix it, how we go about doing that. If it's an advertisement issue, there's not as much leeway there, though there is some a new law that's going into place for this next budget season that does allow you to make up some of the issue associated with an advertisement issue. It's something that we're calling systemized penalties. I won't actually get into it too much here, but we will be releasing further guidance on it. Basically, it does provide an option where, let's say you advertised a zero levy in a particular fund and you actually meant to have a levy in that fund. You may be able to do a new advertisement and you would get There's different constraints on it, but theoretically you'd get about 95% of what you originally wanted. So that's the general concept, is let's try to soften the blow a little bit when inevitably we always have some units that advertise incorrectly. So let's soften that a little bit, give them a way to try to resolve that and get some of that money back. So going forward, the department will be releasing a lot more guidance on that. We are working through all of our legislative memos currently, so in the next couple of weeks, you will start to see those coming through on our DLGF listserv. All right, the other thing that you can start right now is working with your department heads and getting them to be thinking about budgets, getting them to start to think through what their budget requests are for 2015. Next, we're going to jump into the timeline for the 2015 budget. So first, we'll actually start with a date from last week, March 31st. March 31st is the date when your sales data needed to be submitted to the state. These are files that will come to us through the county assessor, and they are used in our ratio study review process. So it really is the first step when we start to see counties who have not submitted their sales data, and it's getting later and later into the year. That's when we start to get a little anxious. You start to get the phone calls first from our data division, and then you'll start to get phone calls from the commissioner asking what's going on. So let's try to avoid that as much as we can. We actually have been making great progress. We are ahead of where we were at last year at this time. The information I have here is as of this past Monday, we were at 49 sales submissions out of 64. I believe those numbers are higher now. We really are receiving these sales submissions on an ongoing basis and completing our reviews on an ongoing basis right now. After the sales are approved, the next step in the process then is the submission of the ratio study. For those of you who may not be too familiar with that particular document, that is where you look at your assessments that you currently have in place on properties and compare it to the sales prices and kind of see, are your sales prices trending up or are they trending down? This is an annual adjustment process then that we go through to adjust our assessed values so that we can more closely equal our market value, which is our market value and use requirement for assessments in Indiana. So this is a process a lot of people will call trending. And so the ratio study really is the statistical document that determines how much we will trend values up or down. There actually is not a statutory deadline for the submission of the ratio study, but for our purposes, we do have a recommended date of May 1st. Given the other tasks that have to happen after this particular document gets approved, it's really important to try to get that to us right around the May 1st timeline. That gives our assessment division sufficient time to complete their review, and then ultimately it gives the assessor more time to complete their process of getting the values to the county auditor. As of this past Monday, we had 4 ratio studies that had been submitted, and 2 of those had been approved. That's the other benefit. If you want to submit your ratio study now, we've got, unless you're going to submit on a Friday afternoon, if you submit in the middle of the week, right now we've got about a 1-day turnaround on things, because we're geared up, we're ready to go, we're just waiting for that information. So if you have any concerns about us getting our work done, get it in now. We'll make sure we get it done. All right. After the ratio study then comes the end of June, and that is an important date for a number of different reasons. The first one is that will be the official settlement date for your May tax collections. I know many counties will actually do settlement in advance of that as they have it completed, and that's excellent. But this is kind of this is the last day to get it done. For our purposes, it's really important that this does get done because it will impact your budget forms going forward. In addition, June 30th will form the start of our budget numbers. Because of the way we have to do our budget process and the way that you all are adopting your budgets in the fall, At that particular point in time, you don't know where you're going to end for 2014. So what we do in order to accommodate that is we start from June 30th of our current year as the starting point for all of our calculations. So when we are looking at our budgets, we really are looking at an 18-month period. Or some people would even say it's a 24-month period, depending on how you want to factor in your operating balance, which is really designed to get you through the first 6 months of the year after the budget year. So in this case, the first 6 months of 2016. But we definitely are looking at 18 months. So these cash balances as of June 30th, that is a number that we look to get financial records from taxing units to verify where they stood as of June 30th in terms of their cash balances and their investments. At that point also is when a unit can start to prepare their current year financial worksheet, which is a document that will ultimately populate about half of this form that we call the Form 4B. The Form 4B is kind of the be-all, end-all of our budget process. It's the final one that says, here's what the budgets will be, here's what the levies will be, and here's what the rate will be. The numbers on the Form 4B will actually roll through Gateway. They'll go on to the budget ordinance or resolution that will be adopted and signed by your council. So that Form 4B is really important. So at the point that you have your June 30 information, you can actually start to work on completing the information that will go on that Form 4B. Also, right at the end of June, start of July, there is a statutory deadline for the county assessor to roll the gross assessed values over to the county auditor. So that is exactly what it means is county assessor has their final gross assessed values for the next year, so in this case for pay 15. And so then they give that information over to the county auditor. That's the start of the auditor's time frame. They have statutorily, they have 1 month to complete a lot of different steps in this process. Let's see. All right, we're actually going to jump to that. What are the auditors doing in July? In the month of July, there are a couple of things that have to happen. In the auditor's office, they are ensuring that all of your deductions and exemptions have been applied correctly. They also are making any adjustments that are necessary for tax increment financing districts, if you have those. The redevelopment commissions have a July 15th deadline to notify the county auditor and other taxing units if they are going to want to take all of their assessed value and keep all of the revenue off of that assessed value, or if they have excess revenue that they can actually release to the other county or the other taxing units. If they are choosing to release, it's very important that we get this in the mid-July timeframe so that the county auditor can ensure that they have built that into the final certification of net assessed values. Another thing in particular with TIF that the county auditor is working on in the month of July is completing a TIF neutralization worksheet. Because of annual trending, what the neutralization is designed to do is to, what's the best way to say this? It's designed to actually change the base assessed value in a TIF district so that a TIF is not seeing a windfall because all of the assessed values in the county or all of the assessed values in that area may have gone up. TIF is really only supposed to see growth from actual real growth, a new building being located there. So if you're in a situation where in your county, all of the AVs have gone up because your sales have been, your sales prices have been higher than your assessed values, and so you're going to start to move your AVs up to get more in line with market value. You don't want TIF to get the benefit of that just because all of the values are going up. So this TIF neutralization process is designed to try to get rid of some of that. All of this leads up to the August 1st deadline. This is a statutory deadline for county auditors to submit the net assessed values to us. The net assessed values In order to get to those net assessed values, obviously they have taken the gross AVs that the assessor gave to them, and now they've removed all of those deductions and exemptions and made any other modifications that they may need in order to get to these net AVs. The net AVs are very important to us. These are the numbers that we will base your calculation of tax rates on for the purposes of your budget order. They also will tend to determine where you fall in our budget review process. For the purposes of the budget division, we have a team of, it keeps being in flux. Right now we're at about 10 people. Pretty soon I hope we'll be up at about 13 budget field reps. So we have a number of individuals, each of which have an assigned number of counties. As they are looking at their assigned counties, ideally what we will do is that if one county submits their AVs on August 1st and another county submits their AVs on August 5th, the county that submitted on August 1st should be our first county for budget review. That is our general policy. I will say that that doesn't always happen, so if you're concerned about that, please, you can certainly reach out to me and I can explain to you why that didn't happen. Sometimes there are other things happening with the taxing units in a county. If you have a school that's taking out new debt by the end of the year, we won't be able to complete the budget order until that particular thing is completed. And then there are some other reasons why the counties might get moved around a little bit, but general policy, the sooner you submit, the sooner you get your budget order. All right, I'm going to jump back a couple of slides to something here in the months of July and August. This is when the department is conducting what we call our budget workshops. During budget workshop time, our field reps will go to each of their assigned counties, and they will spend typically 3 to 5 days in each county visiting and meeting with each taxing unit. It's a great opportunity to work through any questions that you may be having. They can assist with actually preparing documents. So it's a very key time to keep in mind that we're going to be around in person. You can actually come and meet with us and get help on your 2015 budgets. If you are going to come to workshops and work with us, we do ask that you do some initial prep work, things like preparing your own calendar, when you expect certain meetings to occur, as well as preparing some of the initial line item budget type documents. But as we get closer to workshops, your field reps will be contacting you to let you know when we will be in your county and what information we would like you to have prepared. Skip that. Okay. Let's see. Next, I did skip one slide there talking about assessed values withholding. Essentially what that is that when you submit your net assessed values on August 1st, you do have the option to hold back 2% of your assessed values in any given taxing district. Well, it's up to 2%. If you wanted to withhold more than that, you do have to get approval from the department. Why you may want to do that would be if you anticipate a lot of deduction filings still between the time that you submit your net AVs and the end of the filing deadline, which in this case is now January 5th. If you anticipate a lot more coming in, you may want to ensure that you're withholding an adequate amount, as well as if you anticipate appeals to be coming through, you might want to make sure that you're doing that withholding. So after that, then we get to September 2nd. This is really kind of the time that you start to see our DLGF budget paperwork come into play. So for September 2nd, this is the deadline for taxing units to submit information to the county unit if they have to go through non-binding review. And it's also the deadline for a unit that has to go through binding adoption to make sure that they have prepared their information and given it to the unit that has to do their binding adoption. We will talk a little bit more about that later, so I won't go into detail on this here. But these submissions are done through Gateway, and it is the taxing unit's responsibility to make sure that they are submitting it correctly. So let's deal with non-binding review in this case, or non-binding recommendation. It is the responsibility of each of your townships to make sure that they have gone into Gateway and submitted that information to you. If they do not do that, there are penalties associated with it. Same thing for all of your other unit types that have to go through non-binding review. All right, then from there in September, we are looking at September 13th. This is going to be the last day for you to advertise your proposed 2015 budgets and levies. It also, it goes in this document that we call the Form 3, or it's the Notice to Taxpayers. This also includes information about when you will be holding your public hearing for your budget process, as well as when you anticipate doing your budget adoption. This particular publication, the first publication, you need to make sure that it is done at least 10 days prior to your public hearing. Then there are some other time frames that you have to keep in mind, and we'll talk a little more about that next. But one thing that you will be seeing come from the department, and hopefully fairly soon, is some guidance on this particular process. Let me go here. There has been a change to the advertisement process. I know I had said that our process is fairly stable. This is the one change that has occurred. And while from a taxpayer standpoint, I would say this is very significant and will be even more so going forward, I wouldn't say that for you all as a process, this is going to impact things too much. Statutorily, we have changed the requirements for the advertisements so that for 2015, in addition to advertising in your newspaper, you do also need to make sure that you have officially submitted your Form 3 on Gateway. This is guidance that we've had out there for a number of years now, that we've encouraged you to do that. And then we actually, as those forms are submitted, we make them publicly available on our Gateway public output side. So if you have a taxpayer who's interested to know when your public hearing is going to occur, they can go to our Gateway site. There's actually a way for them to drop in their address, and it pulls up all of the public hearings for their taxing unit. So that has been there, and we've been recommending it. Now it's official. Now this is a requirement. The other thing to keep in mind with this is that this is also what we are going to use to determine whether or not the advertisement was done correctly. So we've always looked at proofs of publication, and we're still going to be looking at proofs of publication here for 2015, so I don't want you to think you can get away from doing your notice. We are still going to be gathering that information and reviewing those, making sure that process has been done. But for our purposes, this online advertisement is the controlling document. The reason for this is 2016, barring any changes through the General Assembly, 2016, the newspaper advertisement is gone. It's only online ads from 2016 on. So, you know, we've been really encouraged over the last several years with all of the local officials and the way that they've adapted to Gateway. We very regularly get good feedback from officials and from taxpayers. And so we kind of just wanted to say, let's move this forward. This seems to make sense. That way it's always accessible. You know, it's not that you're looking for the advertisement in a particular newspaper on a particular day. It can be 2 a.m. and you're interested, you go out to Gateway and you can pull it up. So we're very excited about that. All right, next then we have September 20th. This would be, for 2015, this will be the final day that you can advertise your second publication. So this is the newspaper publication. This particular advertisement does have to be at least 3 days before your public hearing and at least seven days after your first publication. So again, there are some requirements here in terms of that timeline. At this stage, for September 20th, there is nothing else that you need to do on Gateway because you've already submitted it. It's publicly available. So Really, for the online ad part, it only matters for that first date. All right, after that, then we have October 1st. This is the last day for the county council to complete their non-binding review process. This is when they take a look at all of the different forms that were submitted to them by the various units and issue a recommendation if that is required. Again, we'll talk about this a little bit more later, so I won't beat a dead horse right now, but you do need to make sure that for the majority of your units, except for schools, you do have to actually issue a recommendation and tell them, here's what we think. There's a lot of different ways that recommendation can be done, but just make sure you are actually recommending something. So that's something we look for when we're completing our budget reviews. All right, October 22nd then will be your last possible day to hold your public hearing. You certainly can hold it earlier. We highly encourage you to hold it earlier, but this is your last possible day for you to complete that. The reason for this is that it does have to be 10 days prior to your budget adoption. And November 1st is statutorily your last possible day for you to do your budget adoption. So again, please don't wait till the end. We definitely would prefer to see these done earlier. But if you need to, you do have all the way till November 1st. The other note I have here then is saying that submission of the budget forms then need to be completed through Gateway within 2 days of your budget adoption. And again, that's what we've been doing. So I think everybody's pretty familiar with that. And you're also, if you've been in a situation where you haven't submitted your forms yet, you're probably familiar with the fact that we're using Gateway to track that. And so the later and later it gets in October, we're starting to contact you a lot more. So it's our way to try to make sure that we can get as many units compliant as possible. We don't want somebody to mess up on something like this. One of the reasons why I say that, you know, we really encourage you to do your work early and get all of this submitted earlier is that, particularly for this past season, we actually have changed the way that we work internally. And so we have been able to start our process earlier. In the past, we always had to wait until after this November 1st deadline to get the information, even just get it out of Gateway and start to work through it. We modified all of that this past year. I'm happy to say that we started on October 16th this last year. So if you're in a situation where your county and your taxing units have all adopted in early October, then by the time we have our process in place, which hopefully will be early to mid-October again this year, we're going to go ahead and get started. There's no need for us to wait until after November 1st to do that. So it just kind of helps us too in terms of keeping everything on pace. Do you have a question?
Yes. When you say last possible day, November 1, I was just checking my calendar, that happens to be a Saturday. Does that mean that we need to do it on October 31st since November 1 is the last possible day, or do we have until the next Monday?
I believe in this case, this is not one of the dates that you can roll to the next Monday. Or if you wanted to meet on a Saturday, we have seen people do that, which is why I did leave this as November 1st. Yeah, there are some dates of ours that do roll to the next business day. This one in particular is not one of them. All right, so we've already talked about this a little bit, but next we're going to jump into non-binding recommendations and binding adoption. So first we're going to start with the non-binding recommendation. And that is exactly what it is. The county council has to look at proposed budgets and levies and rates for the other units in the county, and they issue a recommendation. It is non-binding. So the concept here is that we were trying to, you know, get additional oversight, certainly get additional opportunity for the public to see what's going on and to weigh in. But at the end of the day, it is non-binding. So don't feel bad if you say to a unit, I think you should do this, and they don't follow you. They actually are allowed to do that. So the units that have to go through this are, the vast majority of units will be going through this. So it's going to be any unit that does not have to go through a binding adoption, which typically will be Units that have an elected fiscal body, so your townships, your cities, towns, they're all automatically going through this non-binding review process. And then also libraries that have appointed boards, but the growth in their proposed budget is less than the assessed value growth quotient. We'll explain that concept a little bit more detail a little later, so I won't go into it right now. But each year for libraries, it's a little different. They have to see how much they're growing their budget in order to see, do they go to non-binding or do they go to binding adoption? It is the library's responsibility to make that determination and to ensure that they have adequately informed any of the involved taxing units. So just keep that in mind. All right, information to be provided by the different taxing units. For any non-school unit that has to go through this, they do have to submit their proposed budgets, levies, and rates. For schools, schools are not required to submit their proposed budgets. They are only required to submit their proposed levies and rates. And all of this is on Gateway. We have a process through Gateway to do this submission. Once your units have submitted, as the county, you have the ability to go in and dump that information out in Excel form or dump it out in PDF form. So hopefully that's been a little easier for everybody to use. That's something we implemented last year and got some good feedback on it. For the county responsibilities, non-school units, first you need to review what they submitted. What are they proposing for their budgets, levies, and rates? And then secondly, as I mentioned, you need to issue a recommendation. As part of that recommendation, you are supposed to be including a comparison to the Indiana assessed value growth quotient, as well as your county's, essentially your county's assessed value growth quotient, and also comparing the increases in this particular unit to increases that other taxing units in your county may be proposing. All of that is built into the form. There's different areas there to complete some of that, but it's all on there as you walk through the form. For schools, the county responsibility is only to complete a review. So you have to look at it. And my guidance to counties is always to make sure that you've documented that you looked at it. We actually have had some issues with that in the last year or so. So make sure that your minutes say, we reviewed the form from this school. That's just a way to cover yourself. There is no recommendation that is required. With non-binding recommendations, there are a couple of possible penalties if this process is not completed appropriately. So I already mentioned the first one. If a taxing unit fails to file their non-binding recommendation form by the deadline, then that unit will have its most recent budgets and levies continued into the next year. It is their responsibility to do it. This time frame at the end of August, early September, that's another time frame where there's a lot of contact by the department out with different taxing units. We won't be contacting the county necessarily at that stage because you all don't have to submit anything right at that time. But the other taxing units were doing a lot of emails, and come September 1st, September 2nd, we're doing a lot of phone calls to make sure that we get as many people submitted as possible. On the county side, we had said earlier that October 1st is your deadline to complete this process. If you do not perform this process by that date, then that same penalty will be associated with the county. So it would be looking at a continuation of your budgets and levies. Fortunately, we don't really have this issue. You all are great about getting this done and making sure that everything's taken care of. So I just point this out that it is out there, but I don't anticipate a problem. All right, next then we have binding adoption. Binding adoption that is a process that is in place for two different types of units. First would be taxing units that have appointed boards. And this really should say non-library taxing units with appointed boards. So there are a lot of special districts that are going to be coming to you. So solid waste districts, conservancy districts. Well, conservancies are a little different. Some are appointed, some are elected. We have, I think, 13 or 14 schools throughout the state that do not have an elected board. They have an appointed board, and so they're going through this process as well. In addition to that, a library that has an appointed board that is choosing to grow their budget by more than the assessed value growth quotient, they're going to go through binding adoption as well. For this purpose, what we advise is that the units that have to do their binding adoption process, they complete as much of the forms on Gateway that they can prior to September 2nd. At the end of September 2nd, we flip a switch in Gateway, and those folks from those units, let's use a solid waste district just as an example. You have your solid waste director. Up until September 2nd, they are in Gateway, they have edit access, everything's good to go. September 3rd, they're read-only, they can no longer edit. And at that point, then the county auditor's office is the only unit that has the ability to do the editing and submitting. So we do control this, we do advise people, especially if you want to keep as much control as possible over your budget, do as much work as possible in advance of this date. The appropriate fiscal body, which I'll get back to that in just a second, but the appropriate fiscal body is responsible for doing the publication. Statutorily, it does say that it's their responsibility. So that is something to keep in mind as the county. If you're doing binding adoptions, make sure that you are not only publishing your budget, but you also are publishing the budgets of these other units. In some instances, they may work out a deal that, you know, this particular taxing unit that has to go through binding adoption, they're still going to make sure that they get the advertisement done. If the advertisement is not done correctly, even if it's the other unit who said that they were going to do it, because it's your responsibility as the county, you will be penalized. Actually, both of the units are penalized, the county and the unit that you're doing your binding adoption for. But we ultimately come back to where the responsibility is statutorily, and so that is with the county. So I love it when taxing units say, hey, I'll take care of this. Make sure that you're checking it and make sure it got done right. So just kind of a word of advice. The taxing unit, even though they're not responsible for publishing it, they are still responsible for paying for that notice. So that is at least one good thing. All right, appropriate fiscal body. You're going to keep hearing me say this. There are all sorts of rules about who is the appropriate fiscal body. It really depends on the unit that has to go through binding adoption and where they fall geographically. If they're fully contained within a city or town, then generally speaking, they most likely will go through that city or town council rather than coming to the county council. But there are all sorts of specific rules about this. And so again, on this, in terms of determining who the appropriate fiscal body is, we do work with those individual units that have to go through binding adoption, and we encourage them to make sure that they know who they're supposed to go through, and they're working with that fiscal body to make sure things get done. So the appropriate fiscal body then will conduct the public hearing. They will also do the final budget adoption. The fiscal body can reduce or modify the proposed budgets that the unit submitted, but they cannot increase it. So that's just something to keep in mind. But this process in particular is very similar to what you do for your own process. Make sure you do your public hearing, make sure you do your adoption, all by the same deadlines. So nothing has really changed there. Once the adoption has occurred, a representative for that appropriate fiscal body, or in your case, the county council, they will go ahead and submit the information for that binding adoption unit through Gateway. So typically it's the county auditor they will have submission rights not only for the county, but also any other unit that has to go through the county for adoption. All right. So that is kind of our normal spiel, which actually you can kind of tell because I was perfectly timed to an hour, which is normally how much we're allotted. That's our normal spiel in terms of this budget process. And it's all very good information. And it's really, there's a lot of points there where you can start to get into some trouble. So if you're concerned about any of that, reach out to your budget field rep. We are happy to help. We are here and we're happy to help. Next, I want to transition a little bit into some stuff that we don't normally talk about, but I am hoping that this is helpful for everyone. So I've titled this maximum levies, but that's slightly misleading. What we are going to talk about are actually three different types of funds. The first one is levy-controlled funds. These are the funds where when you say, what's my county's maximum levy, these are the funds we're talking about. Then after we talk through that process, then we'll also talk about rate-controlled funds and need-driven funds. So levy-controlled funds, that's very simply, that's exactly what they are. They are controlled by the maximum levy for the county. Counties, at this stage of the game, counties will typically have only one maximum levy. Years ago, when counties had a lot of other responsibilities for welfare, they had maximum levies specific to certain funds. Over the years, as those have gone by the wayside, there's now what we call your civil maximum levy. It's one number, and that is the total levy that you can give to all of the funds, the sum of all of those funds that are levy-controlled funds. We'll walk through that example in a second. But similar to the way that counties used to have multiple levies, there are many other unit types that do still have multiple maximum levies. Townships is an example. They typically will have a civil maximum levy and a maximum levy dedicated to fire. All right, this is a slide that is very hard to say in words, and so the next slide is an example. But I said that you have one number, or you have one maximum levy, and that is applied to all of your levy-controlled funds. That means that for every dollar that you give to Fund X, that's one less dollar that you can give to Fund Y. So it's very important to understand that, and this starts to come back to that concept of setting your priorities so you know where you want to be funding. So let's walk through this as an example. This is just a sample generic county that I created. So for this particular county, they have 4 funds that we are calling levy-controlled funds. They have a general fund, they have a reassessment fund, a health fund, and I'm also including in here a cumulative capital development fund. We'll talk a little bit more about that in a few slides. But overall, the certified levy that we have computed for this particular county is $825,000. Their maximum levy that we could possibly give them was $825,457. In the next slide, I'll show you why, even though they're slightly below their maximum levy, we're going to say they're right there. With the way that our tax rates are set to 4 decimal places, it is extremely rare that you can actually hit your maximum levy. One of the best things I heard last summer when we were out doing some budget presentations was there was one particular clerk treasurer who strives every year to be within $100 of her maximum levy. Like, that is just her goal. And given her assessed value, that it's actually kind of a hard goal to achieve, but she apparently has been very good at it in recent years. So talking about that concept, are you at your maximum levy? The kind of quick and dirty way to figure out whether or not you're at your maximum levy is to look at your net assessed value. So I have an example here for my sample county. their net assessed value is 878 million and some change. So for you to see very quickly where you're at compared to, are you at your maximum levy? Just remove those last 6 digits. So remove the and change, you've got the $878 left. So long as you're within $878 of your maximum levy, then you're as close as we can possibly get you. If we gave you any more than that, you'd be going over your maximum levy. So just kind of an easy tool. It's something that we use as we're completing our budget review to kind of get a feel for where everybody sits and how quickly we can get things, recalculated and things like that. So just one of our little tricks of the trade. All right. The maximum levy itself is a statutory formula. There are a number of different steps that go into it. So I'm actually going to walk through the general concept, and then we will get into the detailed calc. But theoretically, the concept here is that your maximum levy year over year, it's supposed to grow by what we call the assessed value growth quotient. And I've already said that word a couple of times, or AVGQ is what we call it. The assessed value growth quotient has absolutely nothing to do with assessed value growth. I think it used to, but it no longer does. It is actually based off of the average change in non-farm personal income over the last 6 years. So it's just something to be aware of, because especially now, I know a lot of taxing units, you're really being driven by, what's going on with your LOIT revenues, and, your economy and what's going on in your county is impacting things a lot for your LOIT revenues. It's also impacting what's going on with your maximum levy. It's just not as a direct of a connection, but it's all based on the same type of information. This is a number that is computed by the state budget agency, and they typically will release that information right at the end of June. When they release it, they send it over to us, and then we throw it out on our listservs. So certainly if you're anxious about this, make sure that you're on our listserv, and that's going to be the quickest way for you to get the official number. Just as a point of reference, here's what has been going on with our assessed value growth quotients in recent years. The maximum assessed value growth quotient is 6%. You'll see that we have not been anywhere near 6% recently. We have seen some downturn in our assessed value growth quotient. Particularly last year, we saw a dip from where we had been for the last few years. Part of the reason for that is because of the years that are included in the calculation. For the 2014 budget year, that assessed value growth quotient would have been calculated with 4 years in the recession and 2 years before the recession. So, that definitely drives how much you're allowed to grow your maximum levy. So once that assessed value growth quotient has been released, or if you make your own projections about that, or someone gives you a projection about it, kind of again, the quick and dirty calculation of your maximum levy will be to take what we call your working max for the prior year, your working maximum levy. That is a number that you can find on your 1782 notice. If you have any questions about what that is, certainly reach out to your field rep and they can help you see it and know where to find that on your 1782. You'll see in a little bit why we call it the working max. But what you can do is take your prior year working maximum levy, multiply it by that assessed value growth quotient, and that will give you a general feel for where you can anticipate your maximum levy for the next year. It's not going to be perfect, so don't come yell at me if you use that and you adopt everything exactly by that formula and it means that you leave money on the table. This is just kind of a quick way for you to estimate. In terms of the actual calculation that we go through, it is much more detailed. And so the next couple of slides will walk through that. So really to start, we start with last year's maximum levy, not the working max, just the normal max. And that's actually, even in some of our internal databases and things like that, it's called the normal max. I think it's just left over from a time where we had a lot of other parts to this formula. But the working maximum levy is really what we track as, this is the official levy official maximum levy year over year. So we'll take last year's maximum levy, and if you have a question about that dollar value, it also is in your 1782. It will be on the maximum levy report in your 1782, which for those who aren't familiar, the 1782 notice is a document that we provide to each taxing unit once we have calculated a preliminary budget order for that taxing unit. It allows the taxing unit 10 days to review and respond to us with any possible changes. So it's really just kind of our way of saying, here's where we're headed. You tell us if you like this or not. One of the reports in there is a maximum levy report. So this is where you can get this number. The working maximum levy would actually come off of the fund report, which is also in the 1782. So you take your maximum levy, and in this case, we will add back to it the Cadgett PTRC. This is, if you are a Cadgett county, this is a step that we will do. If you are not a county that collects Cadgett taxes, then we don't do this step. It's a zero there, and it doesn't matter. Property tax replacement for Cadgett is specifically, it is specific dollars that are set aside from your income tax collections to bring down your property tax levies. So it's property tax replacement. So when we are computing your maximum levy, we actually will factor it back in, and so then we can kind of get a better feel for total dollars that you had available for the purposes of taxation and for funding your levies. So we add back in your PTRC. We also would add back in any permanent appeals that were approved the prior year. For a county, that's going to be very, very rare at this stage of the game. Most of our permanent appeals are going to be things like annexations or extension of services, things like that. Counties, you pretty much have done all of that already just by your general way that you're set up. So there's not a lot of options for those for you. Once we have that, then we have the prior year, or in this case, the 2013 results. So in this case, we've got $810,000 to start from. Next, we're going to take that $810,000, and this is where we apply the growth factor. So you'll see I've got the 2014 2.6%. So that now gets us to our new starting point for 2014, which in this case is $831,060. Similar to how we added back in the 2013 PTRC, now we're going to subtract out your 2014 PTRC. So sometimes this is an important concept if you're in a Cadgett county, because if you are in a situation where your maximum levy is changing by an amount that is maybe significantly different than the assessed value growth quotient, look at what is going on with your PTRC. Depending on how the income tax calculations come out, as your PTRC fluctuates upward or downward, that will really impact what happens with your maximum levy. So just keep that in mind. Once we've removed your 2014 PTRC, we then get to what we now call our new 2014 maximum levy. So in this case, we're at $769,060. Now, there's one more thing that we do to it to get back to what we call that working maximum. That's your overall total amount that you can tax. Total amount you can tax for these levy-controlled funds. See, it's complicated. So we're going to take your 2014 maximum levy that we just computed, And now we're going to make certain adjustments to it. For a county unit, you have more adjustments than any other unit type. So some of the adjustments that we will make is that first there are two different adjustments we will make that in this case I've grouped under mental health. These are dollars that you are specifically providing to mental health facilities. They're coming out of the commissioner's budget typically. There is a maximum in terms of what this adjustment can be, but we really do a comparison between what are you anticipating spending, what's your maximum, and whichever one is less is what we'll approve for this levy adjustment. The concept with this levy adjustment is to say, we absolutely want that appropriation to happen, so we're going to adjust your levy upward to make sure you have enough money to do it. So it's kind of the concept behind all of these adjustments. The other major adjustment that you will see is a cumulative fund adjustment. This gets back to that cumulative capital development fund that I showed in terms of that sample county and one of the funds that they had. A cumulative fund is a fund that is designed to store up money over a period of time so that you can then do larger scale projects. You're supposed to accumulate money in that fund. There is an adjustment that we will make that essentially takes all or a portion of your cumulative fund rate and really makes it outside of the maximum levy. It's kind of a convoluted formula, and it involves what you had back in 1984, but it is something that we adjust for each year. If you do have questions on that and whether or not you are fully maxing out that particular adjustment, again, talk to your field rep. In general, most counties are taking full advantage of that particular adjustment, but if you have questions on it, let us know. Then lastly, there is an adjustment for financial institutions. This is something you'll see on the fund report listed as FIT. It involves the amount of business personal property that financial institutions are paying, and we do make an upward adjustment to your maximum levy as a result of that. So at the end of the day, we start from your 2014 starting max of this, in this case, that's 769. We add in all of these other adjustments, and we've now arrived at the $857,457 that we had seen earlier. So, like I said, it's a kind of a convoluted process that we go through to get to these numbers, and they are all driven by statutory formulas. One of the questions that I get fairly frequently, and I'm starting to get more and more right now, and it's a very valid question. Why is my maximum levy different from theirs? My neighboring county, we have roughly the same type of services, roughly the same population, same geography. Why is their maximum levy higher than ours is? I wish I had a perfect answer for everyone, but I don't. The maximum levies, as you saw with the formula that we walked through, they are a year-over-year formula. So next year's maximum levy will be partially driven by where you were this year. The maximum levies were originally established in the late 1970s, early 1980s timeframe. Unfortunately, I don't know what process they went through to set them at that stage of the game. It's actually something I want to figure out. But when they set them way, way, way back when, since that time, they've been rolling forward. So part of the answer to this question may depend on how were your levies set when maximum levies originally went into place. Maybe at that point in time, the two counties were not as similar as they are now. And so maybe there was some reason why your neighboring county got more money for their starting maximum levy. Since that time, there have been various adjustments that have been in place to the maximum levies. In particular, the one that I always highlight is something that was happening in the early 2000s. that we call use it or lose it. Fortunately, use it or lose it is gone now. It's been gone for the last couple of years. But the concept with use it or lose it was if you did not take your full maximum levy in a given year, you lost some or all of the amount that you did not take. So part of where you stand today may be because 10 years ago, maybe the council that was there 10 years ago decided to be fiscally conservative in a year and didn't realize the impact that it was going to have on your maximum levy. Unfortunately, there's not necessarily a process in place to go through and correct that, but that also is what we've seen, a pretty key driver in why different units have their current maximum levy. All right, way back when, before that maximum levy discussion, I said there were two other types of funds that we also would talk about, so I thought I'd kind of refocus us all and come back to those two funds. So the first are your rate-controlled funds. Unlike your levy-controlled funds, where you have that one maximum levy that you can give to those funds, these type of funds have a statutory maximum tax rate. These are typically going to be your cumulative funds. And then at a school or a library level, you also would factor in your capital projects fund. But for the majority of units, if you see the word cumulative in the fund name, this is a rate-controlled fund. They do have a statutory maximum tax rate. In addition to that maximum tax rate, let me see. Yeah, I'll jump ahead just for a second. While there is one overall maximum tax rate for these funds, there also is a statutory process in place for most of these funds where we go through a process where essentially we adjust that tax rate year over year. The concept, again, behind this is almost similar to what we do with TIF neutralizations. The concept was we don't want, if all of your AVs in your county are increasing, we wanted to dial back the tax rate each year so you're not just getting more and more and more dollars built up in this fund. So this is a calculation that we compute through each year in terms of determining what your overall maximum rate can be in this fund. There are, and I said here for most rate-controlled funds, we will go through that. There are certain exceptions to that. In addition, for some of these rate-controlled funds, they will be what we call inside of the maximum levy. So they will be factored into that calculation of using that one maximum levy number. In other instances, there's specific statute that makes them outside of the maximum levy. So it's a rate that just kind of tacks on top of the other funds. It really is dependent on unit type and the particular type of fund to determine whether it's inside or outside the max. Going back to the earlier slide, because this has a maximum tax rate that we're working with, the levy is kind of the plug number. So the amount of dollars that you can actually raise in this fund, it's going to be driven by your maximum rate and your assessed value. So you don't necessarily, unless you're choosing to adopt a levy that is below your maximum rate, you don't necessarily have a lot of say in how much dollars you actually are receiving in this fund. It's just a calculation that we go through at that point. All right, and then the last type of fund is what we call a need-driven fund. Again, pretty clear what that means. We are giving you a levy for a specific need. In Indiana, that typically is only going to be your debt service funds. You are obligated, you've taken out a bond or a lease, you're obligated to repay that. We're going to make sure you have money to repay that. So debt service funds, except for certain very, very odd restrictions, but these are typically always going to be what we call outside of the maximum levy. So they're going to tack on top of all of your normal funds. and they are going to be driven by how much you need to pay. So in this case, the example I have here is that in the budget year, you have $400,000 that you need to pay on your bond. You already have a cash balance and you expect some revenues to come into that fund of $100,000. So simplistically, the levy that you need in this fund is $300,000. There's a couple more steps in there, like everything that we do. But that's the general concept, is what do you need to pay? Let's make sure you have the money for it. All right, with that discussion on debt service funds, that actually is my perfect segue over into talking about protected taxes. And this will be the last main thing that I cover, and then after this we'll open it up for any questions. So the bonus material is all yours, self-study. But certainly on the bonus material, let me know if you do have any questions. I'm happy to walk through that. So protected taxes is something that you may have been hearing about for a couple of years now. We are finally implementing protected taxes. Protected taxes are the easiest way to think of them. Those are the funds that we're going to raise for your debt service funds. I said when we were talking about the concept of debt being a need-driven fund, I said a couple of times, you have that obligation, we want to make sure you can pay it. This is another step in that process. Up until this year, as a taxing unit had a circuit breaker impact because of the property tax caps, all of the funds would have been impacted proportionally to their tax rate. There's an exception if you've had a referendum, but generally speaking, for the 99% of the units, your circuit breaker gets spread across all of your funds based on their overall tax rate. Starting in 2014, your debt service funds will not be taking a circuit breaker loss. Or at least not a circuit breaker loss associated with the 1%, 2%, and 3% property tax caps. The goal here again is to make sure that you have sufficient money to pay that. So if you're taking a circuit breaker loss in your debt service fund, then there's a risk that maybe you would default on your bond because you don't have sufficient money. So the way for us to correct that is to say this is now a protected fund. What that means is your debt service fund, the tax rate associated with that debt service fund is still going to be included in the calculation of your overall circuit breaker impact. So it's still there. We're still looking at your total tax rate. But when we go to spread that impact, it will not be spread to your debt service fund. So all of your other funds will take a higher percentage impact than what the tax rate would seem to indicate. I do have a note here that this does not pertain to over 65 circuit breaker. Over 65 circuit breaker will actually still impact your protected funds, as well as exempt funds. If you have a school that had done a voter-approved referendum in the last couple of years, that is what we call an exempt fund. Over 65 still applies to an exempt fund. So as an example, here's what I've kind of put together. In this particular case, again, this is our sample county. I have some funds for our sample county with their associated tax rates. So next to that, then I've computed out what their percentage of the overall total tax rate is. So you'll see here the general fund is 50% of this overall county tax rate. The circuit breaker loss that is going to go to this unit overall is $100,000. When we spread that $100,000, we cannot apply it to the debt service fund, which based on your tax rates was 25% of your tax rate. It takes a zero hit from this circuit breaker loss. So we now, in the second to last column, you'll see where I have taken that $100,000 and I have spread it to what we call the unprotected funds, really just your non-debt service funds. So In this case now, your general fund is going to take 67% of your overall circuit breaker loss versus the fact that it was only 50% of your budget. So this is something to keep in mind. It will put more pressure on your other funds. You're going to take more of a loss there. So from a theoretical concept, this was supposed to be fairly neutral when you look at the unit overall, because there has been in place for the last several years that if a debt service fund was not able to meet a debt obligation, then you would either pay the remainder of that debt obligation out of another fund, or you would transfer the money from that other fund into your debt service. And so the concept here was, well, instead of doing those payments or transfers, we'll just do that from the get-go, and we'll just keep the debt service fund whole and take the hit against the other funds initially. So again, I say that theoretically, it was supposed to be revenue neutral. I know in some instances, and depending on how people actually do their budgeting, that may or may not be the case. But just be aware that your other funds will be looking to take more of a circuit breaker hit than normal. One of the ways you will find this out is the circuit breaker report, which I have been, myself and the data division, we've been diligently working on this for the last several weeks. And actually, we're hopeful to release those tomorrow, assuming I have one last step I have to get done. So assuming I can get those done, then you should start to see your circuit breaker reports tomorrow. In that report, we will take each taxing unit, break it down by fund for the amount of circuit breaker that they can anticipate in each of those funds. And we have made all of the changes necessary because of protected taxes. With protected taxes, one other thing to be aware of is in Senate Enrolled Act 517 from the 2013 General Assembly session, so 2 sessions ago now, they actually modified the circuit breaker and the protected taxes statute to allow units to do some reallocation of where their circuit breaker losses are being taken. You still will not be allowed to say, oh, I want my debt service fund to take that hit. But among your unprotected funds, you will have a little more control over which fund will take it. We are working on the guidance and the process for that, and that should be released very soon. All right, with that, then this is just my contact information. Certainly, if you have any questions on this presentation, please let me know. I'm happy to talk to anyone. And as always, feel free to reach out your budget field rep, and the vast majority of this they can also help to explain. So.